Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Thanks for being part of our program. Both myself and my co-host here, we're both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays helping people like yourself plan their future. We are here on the weekends broadcasting to be your financial advisors on the air or podcast or whatever it is.
Well, however you're listening.
We're just glad you're listening. Thank you.
Yes. And again, at the risk of sounding needy, go ahead and please rate our...
You're saving this at the beginning of the show. You haven't even listened to it yet.
You're right. Okay. At the end of the show, if you're so inclined and you've enjoyed it even a little, will you please go and rate our show on your podcast provider?
And what's not to enjoy about this program?
There are lots and lots of things not to enjoy about it, but if you could just suffer through that, it's like any other relationship. There's many high points and some low points. And since
it's funny. I've got my 10-year-old, very social kid. This girl, super social.
And how old's your youngest?
10.
Okay,
she's my youngest.
Okay.
So my wife and I had two biological children. They're 25 and 23, and then we adopted two foster children that are 13 and 10.
And so the 10-year-old's highly social.
Why? Because we're crazy. But no, so highly social.
But you seem to have enjoyed this, though. You talk a little bit about them, but you seem to enjoy their company. What are you going to say on the radio?
You're asking me, and a number of things are going through my head.
We're like, okay, maybe this is a conversation for private.
They're delightful kids. They really are. I mean, frankly, we had spectacular kids. But my 10-year-old, she has got lots of friends, but then she'll complain about they frustrate her, and she'll complain about these. And my wife and I are like, you realize that they're all humans, right? And I said, maybe you should think about those things that, like, what are the things that you do that your friends might get annoyed with? Because I think she's at the stage where, to your point, relationships, if they're with humans, there's going to be great seasons and great times, and there's going to be parts of the people that annoy you, and that's just...
And it's the same with your podcast.
The same.
Sometimes you feel like just hanging up on them, but you just stay to the end of the show because you're a giver. So at the end of the show, if you've enjoyed this podcast even a little, rate us, please. What happens is rating turns into revenue somehow through this magic of formula.
Don't know.
We may be launched to a larger stage because of this radio show this podcast at some point in time, Scott.
Spotify's about ready to send us a big... I mean, Joe Rogan got, $100 million? Come on, what's Joe have that we don't have?
Personality.
There's personality. There's that. Interesting guest. There's that.
A high production value.
He doesn't know financial planning like we know.
Oh, that's right. Step over there, Joe. We're coming for you. All right, let's...
And these podcasts aren't 3 hours like his are either.
They're not.
No.
Which I see as a benefit because I've never listened
as well. I was being interviewed on a podcast the other day. Someone else's podcast. It was some financial publication. I don't know what it was, actually. Someone vetted it beforehand because I don't just say yes to anyone who's got their podcast out of their closet. Hey, it's your first episode. Can you be a guest? It's not going to happen. But so at the start, partly I wanted to get this thing done as quick as possible. I said, "How long is this going to be?" He said, "We don't like to have them any longer than 25 minutes." And I thought, perfect.
That's right.
Keep the podcast at 25 minutes, except for Allworth's Money Matters.
In which case, it runs about 50 minutes.
Yeah.
But you're going to love 40 of them.
It's a high majority.
Right? It's 80%. It's a passing grade. Let's go to the calls.
Right, So if you want to be part of our program, 833-99-WORTH. That's 833-999-6784. And if you're listening to this on your podcast thinking, wait a minute, it's a podcast.
How do they know when I'm listening to the podcast? We don't know when you're listening to the podcast. But when you call that number, they will schedule a time for you to talk to us the next time we are in the studios.
Yes, come in the studios and we'll take many calls at one sitting and put together a good radio program.
Yeah.
Well, we think good radio program and a good podcast. It's one and the same now.
Yeah, it's from the MIB studios.
What?
Mediocrity in broadcasting. Rush Limbaugh had the excellence
Was that
in
what it's? Oh, with the mediocrity. Yeah. Okay then. All right. Let's start on the calls here. We're going to talk to Bert in Florida. Bert, you're with Allworth's Money Matters.
Hi guys, thanks a lot for talking to me.
Yeah.
I got to tell you, you are my go-to podcast for Monday mornings because that's when the new episodes come out. So thank you.
Oh, well, thank you. Do you listen? Just out of curiosity, do you listen to many financial podcasts?
I listen to a mix of financial and other, stuff.
All right. What's your question for us?
Okay, well, I've got a good problem that I'm interested in your take on. We've been retired for about 6 years, so we have a good understanding of what our spending is because we use software to track it, and we know what we spend year to year. And the good news is it really looks like we could be spending a lot more than we are. We don't have kids. We don't have any particular charity plans or anything like that. So our estate...
So that puts you in a pretty unique position, right? Because not very often you've got someone at retirement that has no children, and you're in a different position than a lot. So anyway, continue on.
Oh, what it I guess results in is we aren't as interested in leaving an estate or
I understand.
anything like that. It'll be nieces and nephews that don't deserve it and stuff like that. But anyhow, there are a lot of methods out there for determining safe, withdrawal spending rates with a big variation in the result. So I wanted to get your thoughts on how do you determine a safe withdrawal rate, so that we're not eating cat food whenever we're really old, and yet we would like to spend as much of it as we can.
Yeah, we use some pretty sophisticated software to look at all these variables, but when you start thinking about some of the other variables, you factor things in like, well, is there a pension? If there's a pension, are there cost of living adjustments on that? Right? There's Social Security that has cost of living adjustments. Are there fixed expenditures that we know aren't going to be subject to inflation, like a mortgage payment? And so we got to look at those factors first, then to see what is it of the portfolio, because it's really inflation is the thing that we're mostly concerned about in retirement and with portfolio withdrawals. And so it's looking at those things, and then like, all right, if the markets don't work out quite as planned, or if the inflation runs a little higher than planned, are there other assets to tap into that can help offset?
And then the last thing is that the rate of withdrawal over long periods of time should be actually matched to your asset allocation in the portfolio. So what that means is you can't take a 6% rate of withdrawal if you've got all your money in bank savings accounts. The allocation and the withdrawal rate don't match.
Absolutely.
So how much do you have in your accounts combined, everything?
In our nest egg, if you will, it's like 4.1 million.
And how much money are you spending a year now?
We spent over the last 12 months 102,000. In 2020, we spent 96. I'd say, let's say 100 to 120 a year.
This is not counting taxes?
No, that's all in.
That's all your withdrawals, not including Social Security. Or this is how much you spent.
Correct.
Or how much you withdrew.
I guess my question
Correct.
is,
we aren't taking Social Security yet.
and on your expenditures, that 102,000, did that include tax expenses?
Yes.
Okay.
And how old are you?
I'm 64. We've been retired for about 6 years.
And your house is paid for.
Yeah.
What's the value of your home?
About $650.
And what's the next 10 years look like for the two of you?
Yeah, how's your health?
We're both pretty healthy. I mean, we have our own aches and pains like everybody that's 64 does, but we're very healthy.
This is interesting. If you listen to you listened to the podcast last week, and I talked about the couple that had plenty of money and they had different allocations in the portfolios. I would put a spending plan together with you. I would actually, if I was your advisor, I would, and your portfolios, how is it allocated? 50-50, 60-40? You know,
No, right as of today, we're 66% stock, 27 bonds, and about 7 cash in CDs.
you're brilliant.
But most people would love to be in your position.
You're brilliant. You're brilliant. If you were my client, I would arm wrestle you to start getting you to take $160,000 a year out of your account and spending it. And I'd even go a little bit higher than that, because I know that we're going to lower it once Social Security kicks in. And you're going to say to me, well, I don't need it. And I'm going to say to you, of course you don't. And the reason you have it is because you've been diligent with their money. And it takes a change in mindset. It takes a change in mindset. I have a client who is in his 80s, been a client for 20 some odd years, large account balance, large account balance. I had to start sending him $400,000 a year because he would not spend the money. He said to me, I am not going to spend it. You know what I told him? You only fly first class from now on. When you take the cruise, you only stay at the nice. And if you feel like you got a little bit too much money in the bank right now, you take a private jet. And he has done it. He has done it, but he's in his 80s. I wouldn't have recommended the private jet to him in his 60s, but I did recommend everything else to him. So you should, at a minimum, be taking $160,000 a year out. At a minimum, a 4% distribution. Because, quite frankly, let's say you have a normal life expectancy. You're not going to travel in your 80s or go out like you are in your 60s.
He might have a private jet, like your other client.
Well, he didn't have a private jet. He leased the private jet.
Whatever.
He didn't have the. But I mean, your account balances are a little bit different, but the point is the same, right? And so,
I'm sorry.
Oh, go ahead.
Sorry, go ahead. Well, is 4% a good number? Because
it would be for you.
I've read that.
But everything's still. Look, if you had $1 million saved, maybe a little more concern, right?
Yeah.
But you have enough cushion because you've got so much cushion there by the size of your portfolio that you can withstand a lot of things.
And you don't have any children, which was exactly the same as the client that I just talked about in his 80s. He had no children. And he and his wife, and he's like...
And one way to maybe even consider it is at some point you'll take Social Security, and that, let's say it's $50,000 a year between the two of you. Well, you can say, why don't we take 4 years worth of Social Security distributions? We're not now. Let's put it in a separate account. Let's pull down $50,000 a year from that, and we'll take a smaller number out of the rest of your account if that makes you more comfortable.
Right? But the reality is, and I would make the argument that maybe you should be taking Social Security, at least one of you now, to cut the difference based upon your account balance and how we think taxes may or may not be going. But that's not what you called about.
What percentage of the of your $4 million is in IRA? Or 401k?
Of that, it's like, it's 3.2.
Are you doing Roth conversion?
We haven't yet, and the reason is, and I know from listening to you, you're going to hate me for this.
I'm not going to hate you.
We're just highly dislike
Affordable Care Act. We're protecting that.
Nah, you're missing it a little bit there. I'm just telling you.
Yeah, but what's your health insurance cost you now?
About $30,000 a year for the two of us.
I'd run through the calculation because he artificially impoverishes himself to be.
I understand, but it doesn't sound like he's getting a great deal at $30,000.
That's right.
He's got one. You're Medicare eligible when he's 65. He's got another year in that. I'd still look through that.
I would look at that.
If you wait until you're on Medicare, then I would really consider like a good Roth conversion plan
going forward, and then spending more money at a minimum. What you called about, don't take less than $160,000 out of this account, and you're going to get uncomfortable with it. But just try it, please.
Or take $200,000, earmark it for a Social Security bridge, or whatever the number is, until you want to take Social Security. So you can spend that money now.
So what are you telling him to start change the distribution to
just
what?
trying to change his mindset so he feels comfortable about it. That's all.
Right. Yeah. That's right.
That's all
right.
it is.
Right.
It's just
Scott and I. So
Look, you have these dollars because you've been a diligent saver your entire life.
And it's hard to change.
Right? I bet you were saving
That's for sure.
when you were young. You were probably the kind of kid that had trouble spending the money you made from your paper route. My guess.
Well, I'm the kind of kid that had parents in the Depression, and I heard it every day.
Yeah, but so did a lot of your peers, and they ignored it, right? I'm just saying. So, but you did the hard work and saved these dollars. I mean, maybe 1 out of 100 times people get just lucky into it. But odds are you worked hard and you saved diligently for these dollars. And there are a lot of times you went without. You saw your friends doing things that you didn't do, and your kids said, "Well, you don't have kids." I mean, that's the reality, right? So you had some sacrifices, and that mindset is what got you here today. But it's that mindset that is going to.
It's not going to allow you to enjoy.
It's going to have that 4 million go to 5 million to 6 million to 7 million. And then you're going to be like, well, now what do we do? We got now I'm 70 some odd and I've got $7 million.
So that's why I'd start change the distribution to $160,000 a year to begin with and see how it goes. It is a 4% distribution. You've got plenty of room in this portfolio. You've been investing. I assume you've been investing in a similar or more aggressive portfolio for the last 30 years.
Yeah.
Right? Because it came from an IRA, so this didn't grow this way by you actually timing the market or staying in cash. You've lived through this, and you're going to live through it again. And we're going to see other things that shake the market, that everyone thinks the world is coming to an end. And the world won't come to an end. And if the world did come to an end,
it's not going to matter.
It's not going to matter. Right? So appreciate the call. Thank you for listening to the podcast. And
and congrats.
Great job.
Yeah.
You and your wife should be proud of each other. And by the way, you've done some estate planning, I assume?
Yes.
Okay, so you know that you leave the IRAs to charities and the house and other assets to people, right? If you've got charities in mind.
We're not that excuse me, charitably oriented.
Okay.
But right now we have the IRAs and pretty much everything going to a list of people.
Well, there we go.
Perfect.
All right.
Appreciate
the call. If you want to be part of our program, 833-99-WORTH is our number. That's 833-999-6784. We're talking with Tony. Tony, you're with Allworth's Money Matters.
Hello. How you guys doing?
Excellent.
Great. I have a question. It's probably been asked many, many times. I've heard it on your show a few times, but the circumstances surrounding it.
But everyone's situation is different, so.
Yes, and that's why I'm calling, because every time I hear it, I'm like, well, that doesn't fit my.
That's right.
I always wanted to fit my goals anyway.
Well, that's why the financial planning process we go through is called the 7 personal decision points. It's not financial planning for everyone. It's the 7 personal decision points.
Yeah, and we're all different.
Yeah.
We all have different wants and needs and
desires,
fears,
failures, regrets.
Yeah, I wish I had that last guy's problems.
Things we should have done.
Okay, no.
Okay, what can I do?
A list of enemies.
But here's my question. I did retired from the state of California, 2012. So I've been retired a little bit. My wife just retired a couple of years ago, also from the state of California. I am. This is her and I have been going round and round about this for a little while. I want to pay off our mortgage, and the way I want to do it is I want to do it with either my 401 or 457. But I've been told that's not a good thing to do, and so that was my question to you. I know I'm not giving you all the.
Well, here's the challenge behind it. So, the income tax structure of this country and the state of California as well is very progressive. So, if you have little income, you pay really no taxes. And if your income starts going up for federal taxes, at some point, all right, you're going to start paying a 12% tax rate. Then it bumps to 22% tax rate. Then it goes all the way up to a 37% top tax rate today, plus another 3.8% Obamacare tax. So it's really effectively 40 somewhat percent. So your 401k, the taxation on it could be anywhere from 0 to 40% federal, and from the state of California, 0 to 13.3%. And years ago, they used to have an ability to stretch out the taxation of it over 5 or even 10 years. Remember, Pat, there was the
Yeah, it's been
10-year
a
election.
long time ago,
I know, but
though.
they used to allow that. You can take a lump sum. You can pretend like it was taxed out over 10 years. That doesn't happen anymore. So it's all based on the year in withdrawal. How large is your mortgage?
Right now, it's $148,000.
How old are you?
I'm 60.
What's the interest rate on the mortgage?
2.9.
And how much do you have in your 401k and 457s?
My 401 today 680, and my 457 and the 401 has 397.
And your wife, how much does she have?
That's combined.
Okay, so you've got approximately $1,080,000.
Yeah.
Approximately.
What if you did this? What if you took $148,000, or maybe even a tad bit more than that, from your 401k and moved it into a separate IRA, invest a little more conservatively, then have that IRA, whatever that mortgage amount is, have it just send you that check for that amount each month to make the mortgage payments?
So
You
take 100 and let's say 60,000 and move it into an IRA and have it pay me back that amount of the mortgage.
That's a psychological game that we're playing here.
Yes.
How much money do you have in the bank?
You guys, again, like the last gentleman said, you're going to get mad at me. I have about 157,000.
Oh, this is easy. Oh, you're killing me. Tony, you answer the question for us. What do you do?
But I don't want to deplete that.
No one cares. Stop. You have almost $1.1 million in liquid cash. It sits in a 403B and 457. Don't worry about depleting that. Absolutely don't worry about it. If you're worried about liquidity, you've got plenty. How much are your pensions between the two of you?
You mean what's our monthly?
Monthly, yes.
Yearly or monthly? About 16,000.
Okay, and have you touched any of the 457 or 401k since you or your wife retired?
No.
Okay, look. You go down to the bank where you bank, and there's a picture of you and your wife back there, and every day they walk by and they give you a little nod and say thank you because you lent them at 0.5% and then you borrowed it back at almost 3%.
Yeah.
I don't want you to talk about it. I don't want you to think about it. I don't have a dog in this fight. You got to go down, pay that thing off immediately. Write the check.
Okay, but I'm
And you know what's interesting, Tony? You started this call, and you said, "I wish I had the problems of the previous caller, with his 4.1 million." And we said maybe it's realistic to take $160,000 a year out. You've got a pension. You and your wife's pensions are $192,000, and you have guaranteed cost of living. You're much wealthier than the previous caller.
You have much more money than the previous caller. If I did what's called a net present value calculation,
if someone said option door number 8, door 1 is the previous caller and door 2 is you, I would take door 2.
That's right. But yours is viewed differently because you don't view it as a lump sum. But if I did what's called a net present value calculation based on your life expectancy and your wife's life expectancy and put a cost of living adjustment in there.
Anyway, you can do whatever you want.
Yeah, but he called me.
Yeah. Well, you guys are making me feel good now, but I still feel, it just makes me nervous.
Okay, but no one cares how you feel. You're going to do the right thing. This isn't a hard decision. How about this? How about I pay off your mortgage and you write me a check every month that pays 2.9% interest for someone that has stellar credit and will never default on this thing? How do you feel about that?
Well, write me the check.
All right. I would do it. I would do it.
You want to loan him the money?
I'm going to collateralize his home. The home's worth more than $148,000.
I'm pretty confident he's going to make the payments. He's got pensions of almost $200,000 a year.
There's plenty to go after there, right?
But do you think? I get what you're saying. It makes, I look at it. It makes no sense to me. Just take the cash, pay it off, and what are you worried about? But
Thank you.
I do. I have kids. and I have
So what?
things pop up.
So what? But
Then take money from your 401k when you need it.
Then take money from the 401k when you need it. It costs you $3,000 a year not to pay your mortgage off, by the way. That's the spread in the interest rate.
Yeah. And that's why I want
to. Are you doing this because your wife wants to pay it off and you don't? You don't want to show her that you're right?
No, it's the other way around. I want to pay it off, and she thinks that we shouldn't.
Have her call me. You got to pay this off.
Now you want to get me in trouble.
Yeah, you got to pay this off. You
got to
totally agree. Pay this off.
Even if look, just take a little bit out of your 401k. But if you try to take the whole thing out of your 401k, you're going to just pay more taxes.
It's just stupid. It's just, Scott, it's just stupid. Just take the money out of the bank, pay it off. Done. Finish.
We're taking a quick break. Stick around for more Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Glad you were sticking around. Hey, this, some of you guys saw the news. I don't know, it was 6 or 7 weeks ago now, where that ProPublica piece of all that they listed a bunch of wealthy people's income taxes and all that.
Which always surprised me how they actually got their hands on it. Through divorce filings?
No, they figure it was stolen. They don't know if it was an inside job from the IRS or someone hacked the IRS.
Really? Should the press really be running that stuff?
Have you not read in the stories about whether they should have run it or not? I mean, maybe they're a little complicit.
Edward Snowden, the whole thing too, right?
Where's he now? Is he still?
He was.
Did he die?
No, I watched the movie.
So.
Anyway,
there was a movie.
Yeah, there's a documentary about him. But the point being is it really appropriate for the press to be actually running information that was stolen, even though it
is salacious? Like this story here, which here we're talking about. Now I'm guilty of the same thing. Peter Thiel.
All right, what happens if we don't talk about it? We just did all that build-up and then just left the listeners hanging. How would that be?
So, was he a PayPal founder?
One of them.
I forget what he founded a couple companies. Obviously, pretty talented guy. But he has, get this. So the last caller wishes he was like the first caller. This guy has $5 billion in his Roth IRA. $5 billion in his Roth IRA.
And he hasn't put any money in since 1999.
And so he obviously used some sort of stock options or carried interest or something he had in there that at the time looked like it had no value. Loaded up his Roth IRA with something that had no value, and then...
it was 1.7 million shares of PayPal at 0.001 shares or $1,700. He did this in 1999.
There it is. PayPal was worth nothing at the time. I don't begrudge him. He's just following the rules.
But that was an active, I guess that
it's probably the company wasn't worth anything back then.
It wasn't. Absolutely. I mean, that's just a 0.001. But to pretend that he actually didn't have any active role in the management of the company in order to grow that?
Why? What's to preclude you from having some active?
I guess that's a good point. It's certainly not passive. I don't think that's what Roths were designed for, though.
You don't think Senator Roth was thinking about the
Peter Thiel
billionaire PayPal? Is that what it was? PayPal?
Yeah, it was PayPal.
PayPal.
Yeah. Unintended consequences.
Venmo.
Okay.
I'm just saying. I like Venmo.
I haven't spent a lot of time considering my digital payment strategies, but I appreciate that. My wife uses the Venmo and the PayPal.
I'm actually heading to Home Depot as soon as we're finished with this recording. I got to buy some things. And I left my wallet at home, so I don't have my wallet. I shouldn't be driving, but I'm driving.
Okay.
I don't know what would happen if I got
You
pulled
just
over.
give them your driver's license number, which I'm sure
Yeah,
you
of
know,
course
and
I
they would
know.
run it.
I understand. I don't look like some sort of thug.
You're like thug. He's a thug.
54-year-old, 150-pound thug. Watch out.
You're Home Depot.
My point
Let me
is,
show you my. I got ID.
All right.
Look at this Home Depot receipt. Would you tell him?
no, I Googled that. See if Home Depot accepts Venmo, and supposedly they do. So
luck.
I'm going to try to figure out how I use Venmo at Home Depot.
I would ask at the cashier before I went
You
shopping.
think?
Yes.
Anyway, maybe we should hit some calls here.
Yes, you'd like to join the show? It's 833-99-WORTH. That's 833-999-6784. And we're going to take a couple calls. And if we have time, I want to kind of talk about a strategy about whether you should continue to hold something or sell something, and kind of a gut check that you could bring yourself through for whether it's a home or a stock or a bond or any asset.
Now I'm intrigued.
All right.
All right. Well, let's gonna go to the phones now. Let's talk with David. David, you're with Allworth's Money Matters.
Thank you, Pat and Scott. Really enjoy your program.
Thank you.
I have a question on strategy on how to invest $1.1 million. So here's my situation, very unique. My wife retired this year. I retired December of 2015. I am 66. My wife is 57. However, I then opened up my own S Corp about 3 years ago. Hence, it's prospered quite well, and that's why I have this $1.1 million. A little bit more detail so you can help me determine how to go forward.
So your S Corp generated far north of 1.1 million. You paid your taxes, and you've got 1.1 million left.
In cash, yes.
Okay.
Wow, good for you.
Okay. My house is $1.5 million paid in full. My wife's 401k, $476,000. Vanguard 2045, a target fund is where that's at. And I wouldn't keep it there all the time. All the money goes to my daughters. So I do like Vanguard. It's about 88% stock, 35% foreign, and 53% domestic, and a few other things. My 401k, $480,000, same thing. Vanguard 2045 in 5 years, 2 years, depending. I'd probably change it to 2050 to keep that a high stock option because I don't need the money.
Okay.
Last point, pension, $212,000. We need maybe $112 a year. So I have no need for, I don't need any money going into retirement long term. So now here's my scenario. 1.1 million in a brokerage account. And I've talked to investors, planners to help me out. And there's 3 approaches that I'm hearing. And I just don't know how to proceed. And one of my concerns is obviously, the bull market versus the bear. And so here's the 3 scenarios that I'd like to get your input on.
Perfect.
1, go all in right now. If the market starts to go south, we'll go defensive. And if it goes really south, we'll pull out.
I hate that
Number
option.
2.
Terrible idea.
I do too. Next option, go all in, continue to be stocks, diversified, much like the Vanguard 2045. If it goes south, leave it in. Your time horizon is 25, 30 years. You don't need the money. Just write it out.
Okay.
And the last option, which is very intriguing to me, and probably the one that I'd really like to get your most valuable input in, because it's basically, all right, if you got 1.1 million, put 100,000 in 2 stocks every month for the next 13 months. And that way, one of your concerns, if it starts going south, you can stop. And then as it continues to go south, and let's just say it does that after I got 600,000 in, I could go on pause. And then as it goes south, then put the rest, the 500 all in at one time.
Yep.
So I would really appreciate your perspective on these 3 views that have been given to me as I reach out to financial investors.
So what the one that I would agree with most is the last one, and it's dollar cost averaging. And you
Whether
use
it's two stocks or a variety of stocks or a mutual fund.
into stocks, not
got
into right. So I thought I heard the same thing. You're talking about
why they all three were 100% stocks.
Yeah.
Did anyone say let's keep some cash on the sidelines? And
but
No.
oh, and by the way, so what you told us is that you retired how many years ago?
5 years ago,
Okay.
but I'm working as a consultant with my S-corp.
Okay, so you said that you didn't really care about and putting in more money into an IRA or 401k. I'm going to disagree with you there.
I am as well. That was the first thing I was thinking of.
I think that that's a mistake. I assume that you're the only employee of your S corp.
I am, and actually, to be clear, the 5305, I will, through my S-corp, put money into a 401k, but this money is cash. and
Okay,
so
I
it's a
understand.
brokerage
I understand.
account.
So,
but
you could put a lot of money into that.
you've got a couple options. This is made. You made how much money did you clear last year on this S corp?
900,000.
Okay, you have no employees.
Oh, you're thinking defined benefit pension
You
plan?
can set up
A defined benefit
a
pension
Roth defined benefit pension plan and funnel a couple $100,000 into this, if not more,
Yeah.
Oh,
into the
wow.
Roth.
Yes. It's a little. It takes a little bit of maneuvering, and it's you've got to have to set it up, and it costs a little bit of money. But I could make the argument.
Oh my gosh!
And you're thinking Roth, Scott,
Or traditional,
or both.
or both. So you're
Yeah,
looking at
my
the
tax
you're looking at
rate-
the final investment. I'm looking at the tax man's going to take a huge chunk of whatever earnings you've got, whether it's from
50%.
Okay, right? So they're taking a huge chunk. So the first thing I look at is like, if we can save some money in taxes, that's like getting extra returns on our investments.
And so, how a defined benefit pension plan works up is that you pretend.
It's an age-based profit sharing plan.
Yeah, or which actually just it allows you to go higher than the normal 401k limits based upon how
Way
you
higher.
designed the plan. So that's the first thing I would do with if you were sitting in any of our advisors' office. That's everyone wants to talk about the investment, but you skip past. And by the way, you're a consultant, and the reason you make so much money is because you see stuff other people don't
That's
see.
right.
Right?
I'm sure you're pretty good at what you do. You don't make $900,000 being a consultant just because you're
Yeah.
you're handsome.
Yeah, you turn to clients and say, well, I think of it a little bit differently. Are you going to agree with me there, David?
Yeah. And so I have done the tax analysis. I wasn't aware of this Roth,
No,
but
it's a
essentially in retirement versus now, 50% of my income goes to taxes.
Yes.
When I retire, it's going to be 27%. I've done the math.
That's
so
right.
There's a 20% savings in exactly what you're saying.
That's right. And you said 401k, and you limited yourself to a single tax strategy in terms of retirement plans. There are many different retirement plans that are, especially high income earners that are
Yes,
sole
with-
proprietors.
with no employees. I mean, it's like you're like the poster child.
Like
for,
it was written for you. Much like we were talking about how Peter Thiel used his Roth IRA.
Yes.
These are written for you. So there is.
So there's that. And to answer your immediate question,
And by the way, I'm gonna tell you this. You could set up a Zoom. We have a retirement plan division. I normally never promote. I shouldn't say never. I rarely promote our company on our podcast or our show, but we have a retirement plan division, and they will walk you through a couple of different examples of these types of plans and send you information. Because it's a little bit above Scott and my pay grade to tell
well, it's
you
just
exactly.
not we deal with on a regular basis.
Yeah, but we do have a division that does that.
So
Excellent.
to your original question, so you mentioned that these dollars are going to go to your daughters. Is that what you said earlier?
That is correct.
Have you considered having any gifting to them now?
So what we're saying there, gifting is $30,000 a year, 15 each for my wife. Is that what I'm hearing you say?
I just asked if it's something you've considered.
And I would be glad to do that. Absolutely. It seems so small compared to the big figure that I'm dealing with. You know, the 1 million in my 401, or both our 401ks added together, and then the 1 million cash that I have right now.
And his pension that's covering more than his
correct.
needs.
And are you in Social Security now?
I am, and that includes the 212 annual that I'm getting.
Is your wife on
My
Social
wife
Security?
is not on Social Security yet. Rough estimates, when she gets Social Security, it'd be whatever's higher, hers or half of mine.
Yeah.
And are you going to make? Will you
somewhat-
make $900,000 again this year? Somewhere in that range, and the following year as well.
Yes.
So So the bigger question to me is not do we dollar cost average in, or it's the bigger question is what do you want these dollars to do? Do you want them to make your daughters rich? Do you want to help a nonprofit? Do you want to? I mean, you have a lot of options, and those are the more difficult questions.
Actually, it's very easy. So I already give about 15% of my annual income to charity.
Mm-hmm.
So the rest of the
Good for
money,
you.
it's really I want to give it to my daughters, and so it's wealth management. I was not aware of the tax, or not the tax, but
The pension.
putting that amount of money.
Yeah.
Away.
You're not going to be able to get all 900, but you certainly could get hundreds of thousands. But you and 99.5% of the population, how would you know? You've never made $900,000 as a self-employed.
Exactly. It
right?
was pure,
very few people in the
expected.
United States make $900,000 being self-employed. So I'm going to agree with Scott. I would probably start gifting to your children at $30,000, and quite frankly, I would put it all in the S&P 500.
Consider I don't know your kids or what they would do with it.
Assuming that they're responsible. And by the way, all you have to do is tell them, look, it's your money, do what you want with, but I get copies of your statement, and if you want to see another dime, you won't touch it.
They're very responsible. I have no concerns.
I would start there, and then I would actually design an allocation. I would probably be more prone to go 50% equities, the rest bonds and cash.
Yeah,
and
I don't know.
Do it over a chunk or two.
I think he could be. If the plan is that eventually these dollars will be your daughters, if you take that time, if you think, all right, that's going to get passed on when we both die, which is years from now, you've got a really long-term perspective. It comes down to your real stocks. I mean, 100% stock is a lot. I would dollar cost average in. Whether it's over 13 months or 24 months or 36 months.
I agree with you.
It's just emotionally it's easier. It's not a way to enhance returns. It's a risk mitigation thing.
And actually, had I been your advisor, we would have actually had the defined benefit pension plan in place from the first time you made $900,000, and we'd be investing appropriately. It would have never accumulated like this.
Got it. Yeah.
Right?
So 3 things that I've heard. Number 1, $30K each to my daughters every year. Number 2, this defined pension plan, I'm going to have to get with my CPA, work that up through the S Corp, and try to get as much money into that every year as possible.
Yes.
Thank you.
And then number 3, with the cash that I have right now in a brokerage account, dollar cost average, probably I'm too aggressive, is what I've heard with the stocks.
I don't think so.
I don't know.
I don't think so. I don't think so.
I mean, considering
money.
you're making over $1 million a
You
year,
got
so
plenty
it's
of
like
money. I don't think you're too aggressive. And I don't think you're aggressive at all. For that, you got this guaranteed income. I'm assuming that you retired from a state or municipality, which is why your pension is as large as it is, and that you're contracting back with a state or municipality and a skill set that very few people understand. I'm making tons of assumptions here, but I've been doing this.
You nailed it.
All right, we've been doing this a little bit of time, so. It's not the first scenario we've seen like this. So I agree with all 3 of those premises that you should do. I wouldn't go back to any one of those advisors that I actually met with.
just because they didn't uncover the big issues.
They answered your question without solving a problem.
Yeah, that makes sense.
Right? So
Hey, David.
One of them told me about a SEP.
Yeah, the
Is it
SEP isn't the
5303?
Yeah.
It's $50,000 or whatever.
Yeah, it's not nearly as
Yeah,
much.
that's it. 58,000.
Yeah,
Yeah.
it's not nearly as much as you get out of a defined benefit pension plan. Not even close.
Or an age-weighted. Those have
Profit
changed,
sharings.
so I'm not
Yeah.
exactly sure what's
Anyway.
happened in 2021. But
All right. Well, appreciate the call.
yeah, we wish you well, David.
Congratulations
Yeah.
on your success.
No
and
kidding.
I'm glad you're working in retirement.
You know, the good. It's like I like to say, I like everything about getting older except the physical part, because so much of life just becomes easier. And you look at someone like that; he's got a really unique skill set.
Monetizes it.
Like, good for him, right?
Yeah.
Like, that's what the marketplace is willing to pay for his wisdom at this point. So,
Yeah.
All right, let's continue on. This is Allworth's Money Matters you're listening to, 833-99-WORTH. We're talking to Lorraine. Lorraine, you're with Scott Hansen and Pat McLean.
Hi.
Hello.
My name is Lorraine Morris.
Hi, Lorraine.
And hi, I am 62 years old, and I was previously married from 1982 to 1994. So it was more than 10 years that I was in this relationship. So just recently, my ex-husband passed away.
Mm-hmm.
And so I am trying to see if I qualify to collect benefits, Social Security benefits from his account.
Yes.
Since he recently deceased.
And how is that going for you?
I'm trying to find out first if I qualify, and second, how can I collect?
So the question is, are you eligible for Social Security yourself?
At 62 years old, I think early Social Security.
Are
I
you
would be.
working now?
I am working.
And how much are you making?
About approximately $32,000 a year.
What is the limit?
It's 20 some odd thousand.
Yeah. Are you going to quit work anytime soon?
I plan to by the age of 67.
Okay, so the answer to the question is yes. You actually will have a little bit of benefit there from your ex-husband, but not a lot. That's the answer to the question.
Well,
But
did you marry after the divorce with him?
Never remarried.
Okay.
so you've got a little bit there. But the reality is, it doesn't mean anything because of your age.
Could she qualify
Okay.
for a widow's benefit?
But not until normal retirement age, and then she'd
Otherwise,
go
there's
into
still a reduction.
and then she'd go into his first, and then hers. But my
You
guess
can
is,
you can get a widow's benefit age 60.
understand, but she's still working,
Yeah, so that doesn't work.
right? So she's you're right, Scott. I mean, she's eligible for it, but she makes so much money. And
Did he have a career that had a higher income?
He did. He was in the military. And I'm not sure what career he selected after he got out of the military.
So
But he was working.
The way the rules work right now is because your income is $30,000 a year, even though you're eligible for some widow's benefit, you'd be eligible
Yeah,
at
but
age 60.
You're better off waiting anyway.
You're better off waiting.
Unless you tell me you got a lot of retirement savings.
How much money do you have saved for retirement?
Not much.
Yeah.
Okay. Yeah. So even if you were to start it today, your income is so high that they'd take it back away from you. And by the way,
see.
it will be a nominal amount because this took place
Okay.
between 1982 and 1994. So we go out 27 years, right? And
Yes,
it's based on his the wages back then. I speculate that when you go to take normal retirement, it's going to be significantly larger than any widow's benefit you would have received from him.
Okay.
All righty?
Okay.
All
Okay.
right. Thank you for listening to our podcast, and thanks for calling the show.
You're welcome. Thank you for giving me the answers.
All right.
All
Take
right.
care.
Have a great day.
Yeah, thank
Bye-bye.
you. Wish you well. And it's
Social Security is complicated. It's just
It's
flat
super
out complicated. It's just flat out complicated.
it'll be interesting to see when Congress deals with some of the issues that we're facing with Social Security.
Do you think they will at some point in time? I hope they do.
Like days before. I mean, the government, they shut down the government for crying out loud. They can't even agree to
Yeah.
get the government. So the way it's structured now, the year 2030, 2031, somewhere right in there, we're going to have spent all the Social Security savings.
And we're going to have to make a decision at that point in time.
The way it's structured now, there'd be an across the board, 27% cut in benefits, 23%, something like that, 20 some odd percent cut in benefits across the board.
Yeah, and that will never happen across the board.
And if it does, it'll happen once. I could see Congress not even being able to get the.
And then repealing it as soon as it happens.
Who knows? I mean, yeah,
so by the way, we started the show by talking about this last half of the show about how I think about whether you should continue to own something. And this comes from a call that we had either last week or the week before where this couple bought a brownstone in Brooklyn and were living in it. And then it was a 3 apartment brownstone and then moved to San Diego. And
I don't know why they leave Brooklyn to San Diego. That's just
okay.
Don't understand.
So their question was, we were thinking of borrowing against this brownstone, and it was very, very old. And I thought to myself, what is the barometer? Right? What is the barometer, like an emotional thing that causes? Because what causes you to want to continue to own something? And so this is the barometer I like to use for myself, and I share it with my clients. And Allworth advisors will bring this up in conversations at times, which is, would you buy that today? So people inherit a house, and the house is 100 years old, and they want to turn it into a rental. And the question we ask is, if you wanted a rental, would you go buy a 100-year-old house as a rental today? And if the answer is no, then you should sell it. If you have a bunch of stock or mutual fund, and you ask yourself, would you buy this today, all things remaining equal, and you answer no, then you probably shouldn't own all of it. If you said...
Where it gets a little tricky is the capital gains tax implications, particularly today when, the way things are structured now, there's a step-up basis at death. Should that change...
Then it will change the way we manage money.
Yes.
But you most certainly have to go through that first and then decide if the paying of the capital gain tax is actually worth the liquidation of the particular asset.
Yeah, well... Anyway, I appreciate that, Pat. Thank you.
Well, thanks, Scott. Smart Alec. If we weren't on the air, I'd call you something else, Smart Alec.
Anyway, we're out of time. It's as usual been it's an honor to be with you. Frankly, we've been doing this program a long time, and we couldn't do it without our listeners. So thank you. Enjoy the rest of your day, and we'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.